Do you think it might be different? Because I guess the risk is that there's going to be a lot more retirees than I imagine in the 70s, and so that could be a risk.
Well, it is a risk. It's important to note that we went into the decade of the 70s with on-balance sheet liabilities at about 35% of GDP. We're going into this period with on-balance sheet liabilities at 110 or 120% of GDP, which is to say our debt relative to our gross economic activity is 3 times as big as it was going into that crisis. That's a problem.
Yeah, and which assets? Yeah, so 3 times the debasement.
Yeah, I'm not suggesting, by the way, that your listeners curl up in the corner in fetal position, that things are hopeless. Things aren't hopeless. We'll get through this. We will have a reckoning, a 10-year reckoning or a 15-year reckoning. Those people who make hard choices now and prepare will come through that better than other people. But you do have to act. You have to act on your own behalf. If you are a younger person and you believe that you are entitled to the type of retirement that you have been promised by your government, you need to think again. You need to prepare for your own retirement. You need to begin saving now systematically. You need to live below your means. You have to store some of your savings in investments or in asset classes that traditionally have done well during periods of time when fiat currencies were debased. You have to learn from history, and you have to apply yourself now to protect yourself for this reckoning that I think you need to assume will occur as a consequence of the arithmetic around our debt and deficits. There were 2 broad asset classes that did well in the decade of the 70s. One was public companies that had dominant enough products or market share that they could raise their prices to keep pace with inflation. It's worthy to note that Warren Buffett, through the decade of the 70s, generated 25% compound annual internal rate of returns, not following fads, but rather owning things like American Express, Coca-Cola, See's Candies, businesses that were fairly mundane, but that had products and services that were valuable enough to consumers that consumers were willing to stomach price increases that were commensurate with the rate of inflation. The other asset class, which works very broadly well in periods of inflation, are natural resources, but particularly precious metals. If you look back at the decade of the 70s, the copper price went from 30 cents a pound to $1.50 a pound. The oil price went from $3 a barrel to $25 a barrel. The price of decontrolled natural gas went from 30 cents a million BTU to $12 or $13 per million BTU. Not coincidentally, the gold price went from $35 to some number like $800 or $850. The broad range of resources did well. What did poorly? Long bonds, something where your yield is frozen, but inflation eats up the net present value of that yield over time. Really, really, really murders you. At the beginning of the decade of the 1970s, I think the prime interest rate was like 5.5. At the end of the decade, it was 15.5 or 16. What that means for somebody who owns a 30-year bond is that the purchasing power of their bond coupons is a quarter of what it was at the beginning of the decade. And the principal value of the bond falls substantially as well.